What if I told you a $5,000 investment today was all you needed to achieve financial freedom? I've been sifting through hundreds of dividend stocks and found a few gems that most people have overlooked but give you the best chance of retiring early and wealthy. In this video, we're taking a deep dive into the top 5 dividend stocks that have the most sustainable dividends and offer massive income potential. Investing just $1,000 into each one of these companies today winds up earning you almost $140,000 in dividends, so make sure you stay till the end where I reveal the best dividend stock pick on the market, a company with a strong hedge against inflation and a huge market share in the consumer staples sector. You probably pass one of these big box stores every day and you don't want to miss it. In fact, every day you probably drive by many businesses that pay incredible dividends and don't even know it. We sift through all the confusing data for you and only feature the best dividend-paying stocks on our channel, so subscribe and turn on notifications so you never drive past an opportunity again. Now let's jump right in and talk about the top 5 dividend-paying stocks on the market. Coming in at number 5 is NRIM Bancorp, NRIM. NRIM Bancorp Incorporated is a financial institution that generates revenue through various avenues. The primary way the company makes money is by providing a range of financial services to its customers. These services include commercial banking, mortgage lending, personal banking, wealth management, and insurance. Through its commercial banking division, NRIM Bancorp offers loans, lines of credit, and other banking products to businesses, helping them finance their operations and expansion. The interest charged on these loans is a significant source of income for the company. Additionally, NRIM Bancorp earns revenue through interest income from its mortgage lending activities. By providing mortgage loans to individuals and businesses, the company collects interest payments over the life of these loans. NRIM's personal banking services, such as checking and savings accounts, generate income through fees charged on transactions, account maintenance, and other services. Wealth management and insurance services also contribute to the company's revenue stream by charging fees or earning commissions on investment advisory services and insurance products. NRIM's current dividend yield is 6.18%, which is slightly higher than their 5-year average yield of about 4.29%. NRIM's 10-year dividend growth rate is 16.6%, and their 3-year dividend growth rate is 23%, indicating they're speeding up their dividend growth. NRIM has raised their dividend every year for the past 14 years, landing them firmly in the category of dividend contender. NRIM has been paying a dividend since 1995, but cut their dividend in 2008, likely due to the Great Recession. Between 1995 and 2008, NRIM increased their dividend every year, indicating they value dividend increase and shareholder distributions. NRIM's payout ratios on net income, operating cash flow, and free cash flow all remained below 42% over the past 5 years, though they did pay a dividend with negative operating and free cash flow in 2019 and 2020. NRIM has had strong financial growth over the past 5 years, with net income growing at 10.5%, operating income declining at 8.2%, operating cash flow growing at 51%, and free cash flow growing at 45.8%. If we invest $1,000 in NRIM today with an initial yield of 6.18%, 16.57% dividend growth, and 3% share price appreciation, our yield on cost after 20 years would be 5,419%, and our average annual return would be nearly 27%. Over 20 years, more than $100,000 worth of dividends would have been paid, and we would earn $108,000 on the 20th year. NRIM Bancorp offers the highest risk, highest reward play on this list. The massive dividend growth and historically high yield give us huge income potential, but the short dividend increase streak and negative payout ratios in 2019 and 2020 make me apprehensive about the safety of their dividend, especially considering they cut their dividend in 2008. If there's another financial crisis, I think we can expect NRIM to cut their dividend again. Next on our list is Carlyle Companies CSL. Carlyle Companies is a diversified manufacturing company that generates revenue through its various business segments. The company operates in multiple industries and utilizes different strategies to make money. One of the key ways Carlyle Companies generates revenue is through the production and sale of engineering products. These products include highly specialized materials, components, and equipment that cater to diverse sectors such as aerospace, construction, agriculture, and automotive. The company leverages its expertise and innovation to develop and manufacture these products, earning revenue through their sale to customers. CSL also earns revenue through maintenance, repair, and installation services. For instance, in the construction industry, the company offers roofing and waterproofing services, generating income from project contracts and ongoing maintenance agreements. Lastly, Carlyle Companies generates revenue through acquisitions. By identifying and acquiring companies that complement its existing portfolio, the company expands its market reach and diversifies its revenue streams. CSL's current dividend yield is 1.17%, which is slightly lower than their 5-year average of about 1.2%. Carlyle's 10-year dividend growth rate is 14.9%, and their 3-year dividend growth rate is 17.23%, indicating they're increasing their dividend growth. CSL has raised their dividend every year for the past 47 years, landing them firmly in the category of dividend champion. Carlyle has never cut their dividend and has increased it every year they've been paying dividends. Payout ratios on net income, operating cash flow, and free cash flow have all remained below 43% over the past 5 years, and CSL has not paid a dividend with negative earnings any of these years. CSL has had strong financial growth over the past 5 years, with net income growing at 19.7%, operating income growing at 18.8%, operating cash flow growing at 19.1%, and free cash flow growing at 18.5%. If we invest $1,000 in CSL today with an initial yield of 1.17%, 14.9% dividend growth, and a 10% annual share price appreciation, our yield on cost after 20 years would be 21.5%, and our average annual return would be 11.6%. Over 20 years, almost $1,500 worth of dividends would have been paid, and we would earn $266 on the 20th year. As you can see, this play is much more conservative than the last, but also much safer. CSL has not posted negative earnings on any of the metrics analyzed over the past 5 years, and their payout ratios are extremely safe. The stock has also seen very strong share price appreciation since 2013, hence the 10% growth in our income projections. Personally, I'm waiting on the stock to drop and let the yield spike a little higher, but even at today's prices, it's a good play for the long term. Coming in at number 3 is Nordson Corporation NDSN. Nordson is a global industrial technology company that generates revenue through its diverse range of products and services. The company operates in various industries, including adhesive dispensing, industrial coating, and precision machinery. One of the primary ways Nordson makes money is through the sale of its precision dispensing equipment and systems. These products are utilized in industries such as packaging, electronics, automotive, and medical, enabling precise application and control of adhesives, sealants, coatings, and other materials. The company earns revenue by selling these equipment and systems to manufacturers and end users worldwide. Additionally, Nordson Corporation provides a wide range of related services, including installation, training, maintenance, and technical support. These services contribute to the company's revenue stream by offering ongoing assistance and support to customers who have purchased its equipment and systems. Another significant source of revenue for Nordson comes from its industrial coating systems. The company offers advanced solutions for powder coating, liquid painting, and other coating applications. Revenue is generated through the sale of coating equipment, spare parts, and the provision of associated services. Furthermore, Nordson Corporation generates revenue through its advanced technology segment, which includes precision machinery and components used in electronics, medical, and other industries. The company's expertise in precision engineering enables it to develop and sell products that meet the unique requirements of these sectors. Nordson's current dividend yield is 1.07%, which is slightly higher than their 5-year average yield of 0.92%. The 10-year dividend growth rate is 16.4%, and their 3-year dividend growth rate is 25.4%, indicating they're increasing their dividend growth. NDSN has raised their dividend every year for the past 60 years, landing them firmly in the category of dividend champion. Not only has Nordson increased its dividend for 6 decades, they've also never cut their dividend, indicating management is very capable of maintaining and even growing the dividend through multiple market downturns. Payout ratios on net income, operating cash flow, and free cash flow all remain below 36% over the past 5 years, and Nordson hasn't paid a dividend with negative earnings any of those years. Financial growth has been strong over the past 5 years, with net income growing at 13.9%, operating income growing at 12.2%, operating cash flow growing at 6.2%, and free cash flow growing at 9.6%. If we invest $1,000 in NDSN today with an initial yield of 1.07%, 16.4% dividend growth, and 10% annual share price appreciation, our yield on cost after 20 years would be 25.5%, and our average annual return would be 11.7%. Over 20 years, $1,540 worth of dividends would have been paid, and we would earn $301 on the 20th year. Nordson is another low-risk play. The initial yield is lower than what I typically like to see, but they make up for it with extremely strong dividend growth. This growth has been tracking with the increase in financial metrics, so we can expect the dividend to continue its rise as long as management keeps growing earnings. Given the stable nature of their business and low payout ratios, I don't expect Nordson to cut the dividend, making this company an excellent long-term pick or a stable income source for retirement. Number 2 on our list is Parker Hannifin Corporation, PH. Parker Hannifin is a global diversified manufacturer that generates revenue through various streams across its multiple business segments. The company operates in industries such as aerospace, industrial, and motion control, employing different strategies to make money. One of the key ways Parker Hannifin Corporation generates its revenue is through the sale of its engineered systems and components. The company designs and manufactures a wide range of products, including hydraulic and pneumatic systems, fluid connectors, filtration systems, and electromechanical solutions. Revenue is earned through the sale of these products to customers in sectors such as aerospace, oil and gas, automotive, and industrial manufacturing. Furthermore, Parker Hannifin offers a range of services, including system integration, maintenance, repair, and technical support. These services provide ongoing assistance and support to customers, contributing to the company's revenue stream. The company also generates revenue through acquisitions. Parker Hannifin identifies strategic targets that align with its business and acquires them to expand its product portfolio, customer base, and geographic reach. These acquisitions contribute to the company's overall growth and revenue generation. PH's current dividend yield is 1.5%, which is slightly lower than their 5-year average yield of 1.6%. Parker Hannifin's 10-year dividend growth rate is 12.4%, and their 3-year dividend growth rate is 21.7%, indicating they're increasing their dividend growth. On June 2nd, Parker Hannifin paid a dividend of $1.48 per share, marking their 67th consecutive year of dividend increases. PH's payout ratio on net income, operating cash flow, and free cash flow all remained below 44% over the past 5 years, all with positive reported earnings. The company has had steady financial growth over the past 5 years, with net income growing at 4.2%, operating income growing at 11.4%, operating cash flow growing at 8.2%, and free cash flow growing at 7.6%. If we invest $1,200 in PH today with an initial yield of 1.5%, 12.39% dividend growth, and 10% share price appreciation, our yield on cost after 20 years would be 18.8% and our average annual return would be 11.6%. Over 20 years, almost $1,700 worth of dividends would have been paid, and we would earn $259 on the 20th year. Boring companies tend to be the best long-term picks, and Parker Hannifin is about as boring as they come. The financial growth is nothing to write home about, but it's stable and upward. The initial yield isn't all that exciting, but management has raised the dividend through multiple major market downturns. It's worth noting also that the share price appreciation is impressive and not at all volatile. Over the past 10 years, the share price has almost quadrupled, boosting total returns and accelerating dividend income. If you're trying to buy and hold, there aren't many companies better than Parker Hannifin, except one. Finally, at number 1 is Lowe's Companies Incorporated, LOW. Lowe's Companies Incorporated is a leading home improvement retailer that generates revenue through various channels within its business operations. The company employs strategies that encompass retail sales, professional services, and online commerce to generate revenue. The primary source of revenue for Lowe's is through its retail sales. The company operates a vast network of stores offering a wide range of home improvement products, including appliances, building materials, tools, furniture, and decor. Revenue is generated through the sale of these products to both individual customers and professional contractors. Lowe's also offers professional services to cater to the needs of contractors and commercial customers. These services include installation, repair, and remodeling solutions, which contribute to the company's revenue stream. Professional customers often rely on Lowe's for the provision of products and services for their projects. Furthermore, Lowe's has a growing online presence, enabling customers to shop through its e-commerce platform. Online sales have become an increasingly important revenue driver for the company, allowing customers to purchase products and have them delivered to their homes or picked up in store. Lastly, Lowe's generates revenue through its extended protection plans, which provides customers with warranty and maintenance services for their purchased products. Lowe's current dividend yield is 2%, which is slightly higher than their 5-year average yield of 1.7%. The 10-year dividend growth rate is 29.1%, and their 3-year dividend growth rate is 30.2%, indicating they're maintaining their dividend growth. LOW has raised their dividend every year for the past 61 years, making them a dividend champion. Lowe's is also in the S&P 500 and meets the necessary market cap and daily trading volume requirements to be considered a dividend king, though discrepancies in increased streak reporting has placed them in the dividend aristocrat list. Payout ratios on net income, operating cash flow, and free cash flow all remain below 63% over the past 5 years, with no dividend paid with negative earnings. Lowe's has had strong financial growth over the past 5 years, with net income growing at 21.1%, operating income growing at 20.2%, operating cash flow growing at 8.9%, and free cash flow growing at 8.5%. If we invest $1,000 in LOW today with an initial yield of 1.98%, 29.1% dividend growth, and 10% share price appreciation, our yield on cost after 20 years would be 1,705%, and our average annual return would be 22%. Over 20 years, almost $36,000 worth of dividends would have been paid, and we would earn over $28,000 on the 20th year. Where Lowe's really shines is in their dividend growth. A 30% sustained annual compounded growth over 10 years is ridiculous, and if we see similar growth over the coming decades, that income will be incredible. Many retail stores were hit hard during the pandemic because people shopped online more than any other time in history, but the nature of Lowe's products made them resilient to the move to online shopping. I'm not totally sure if this type of dividend increase will continue, but even at half that growth, Lowe's remains a very solid pick for the long term. These companies present the best opportunities today to set yourself up for financial independence in the future, but there are many other steals on the market today. One in particular is UGI, an energy company trading at a huge discount that you really should take a look at. We did an in-depth analysis of this company in another video, which you can watch by clicking the video card here or the link in the description. Every day we keep our eyes peeled for high-quality dividend-paying companies that help you retire faster and wealthier, so make sure you subscribe and turn on notifications so you never miss a new video. As always, stay safe and take it easy.